So today I want us to talk about, let's start with budgeting. So if time allows, I want us to look at budgeting, then analytical techniques. So look at budgeting, then analytical techniques. What will be left, the key issues that will be left with, because we still have standard costing, variances, transfer pricing. So let's get moving so that we can be able to cover quite a number of things. So budgeting, that's what we need to start with. So for budgeting, this one is more of theory. It's more of theory, and it's not supposed to be of a challenge. So if you're looking at budgeting, so for budgeting is more of theory. So the first thing that you need to understand is what is a budget. So if you're talking about a budget is simply a financial plan expressed. This is a plan which is expressed in financial terms. So a budget, we are taking our plan, then we express it in terms of money. So the plans that we are having as an organization, we are expressing them in monetary terms. That's a budget. So a budget is a plan which is expressed in financial terms. So it is a plan expressed in financial terms. That's a budget, a plan expressed in financial terms. So let's look at the role of budgeting. Why do we come up with budgets? The role of budgeting. What is really the reason behind coming up with budget, or the reason behind budgeting? So why do we need a budget as an organization? So if we budget, it can give us quite a number of advantages. So there are quite a number of benefits we can derive from budgeting. So the first advantage you can talk about is a budget helps us to give the organization direction. So it gives the organization a sense of direction. So the budget is what tells us as an organization, after we've completed this task, what is the other task that is on the way? So a budget, it is a way of giving us a direction, a way of telling us what needs to be done. After completing this particular task, what is it that is supposed to be done? So besides that, a budget also can be used for motivational purposes. So a budget can be a sense of motivation. It can provide a sense of motivation. A sense of motivation. How does it provide motivation? So if we come up with a budget and we are able to do what is on the budget, or we are able to surpass what is on the budget, it tends to motivate. So if the target is that we produce or we make sales of 2,000 and we are able to go beyond that, it tends to motivate. So a budget can motivate if we surpass the budget. So the budget is a motivational impact. Besides that, a budget also, the other purpose of a budget is that it can help us to control activities. So if there is a budget, we can be able to compare what's happening against what is on the budget. So in some cases, we can say certain costs we should not go ahead with these costs. Why? Because they are way above the budget. So we can be able to control the costs of the business to say, no, these costs we are not going to choose maybe option A. Why? Because it's way above what is on the budget. So the budgeting process can also help in controlling activities such as controlling the costs we are going to incur as a business. So besides controlling cost, what else can be the purpose of a budget? A budget can help to communicate the targets. If there is a budget, it helps to communicate targets. So in the presence of a budget, you can be able to easily communicate with your subordinates the targets of the business. So you can easily tell them, why are we supposed to do this? Because for us to be able to achieve this target, maybe we have to increase our working hours. So they can understand you better if there is a budget, because it can tell them the reason behind the action. Then also a budget can be used for performance assessment. So we can use a budget to determine, are we doing good or bad? Because if there is a budget, we are doing good if we are able to, if our performance is lying within the budget. So if we are failing to meet the targets, then it can show that there's poor performance. So the budget can actually be a way to use when we are measuring performance. So then there are different types of the budgets that we can have. So types of budgets. So the budgets that we can have the first one, the master budget. So the master budget is the main budget, which consists of the budgeted statement of profit and loss and the budgeted statement of financial position. So the types of the budgets, we have the master budget. So the master budget, this consists of the budgeted income statement and the budgeted statement of financial position. Of financial position. That's the master budget. It comprises of the budgeted income statement and the budgeted statement of financial position. So the first type of the budget, we have the master budget. Then besides the master budget, so if it's the master budget, it's a comprehensive budget, which is looking at the profit and loss and the balance sheet that we are targeting. Then we can have functional budgets. So the functional budgets, these are budgets which are made at departmental level. So we have functional budgets. So the functional budgets, these are budgets made at, these are budgets made at departmental level. So we can have the budget being made in production. We can have the budget being made in sales department. We can have the budget being made maybe in an investment center. So these are made at departmental level. They are not covering the organization as a whole, but they are covering a certain department of the organization, a certain function of the organization. So they are made to cover a certain function of the organization. Then we have fixed budgets. Fixed budgets. fixed and flexible budgets. The fixed budgets are not adjustable for different levels of activity. The fixed budgets are for defined levels of output. But the flexible budgets link in the resume. The flexible budgets are for defined levels of output. So the fixed budgets are for defined levels of output. But the flexible budgets can be adjusted for different levels of output. So if it is a flexible budget, it can be adjusted for different levels of output. Varusazojena ndeva December. Also, tinshava creator timetable yavo during the week. Anogona kutry kujoin. But nishavaisa somewhere during the week. Vanona kuita Monday 6 to 8. Aiwa ngatry kujoin. Vamwe vatojoina nawe mwari. Types of budgets. So we have the master budget, the functional budget, the fixed and the flexible budgets. Then, so with the master budgets, the functional budgets, the fixed and the flexible budgets, then we also have, I think those are the ones that I wanted to list down. Then let's move on. The budgeting techniques. For us to come up with the budget, which methods can we use to come up with these budgets? So there are techniques that we can make use of when we are hybrid. Hi, Bridget, can you now hear me? Have you managed to connect?
Hi, sir. Yes, I did.
It's all right. So we are looking at budgeting. So we just discussed what a budget is and the reason behind budgeting. Now we are on the techniques that we use in budgeting. So for the December class, I'm creating another timetable for you midweek. So I'll let you know so that you can catch up, because this one, it consists of those, the group also contains those that are writing in next month. So I'll create a separate timetable for you. I'll let you know after the session.
Okay.
Okay, let's proceed. So the types of budgets, we have the master budget, the functional budget, the fixed and the flexible budgets. Sorry, maybe we can also add one more here. We can have the cash budget and the production budget. So the cash budget. So if it is the cash budget, this one is for determining the receipts and the payments that the organization is to make. So we are budgeting the receipts and the payments of the business. So this consists of the budgeted receipts and payments of the organization. So this consists of the budgeted receipts and payments of the business or of the organization. That's the cash budget. Consists of the budgeted receipts and payments. The cash budget consists of the budgeted receipts and payments. Then besides the cash budget, we also have the production budget. So the production budget, this one the production budget is looking at the estimated units the organization intends to produce. So this looks at the estimated units of production for the organization. The estimated units of production for the organization. The estimated units of production for the organization. Now, let's move on. So the types of budgets. Now, techniques in budgeting. So when you're constructing the budget, which techniques can you use to come up with the budget? So when you are constructing the budget, you can use the top-down budgeting approach. The first one, let's talk about the top-down. Let's first of all list them. We have top-down budgeting, top-down and bottom-up. Top-down and bottom-up budgeting. We have rolling budgets. We have rolling budgets. We have zero-based budgeting. Zero-based budgeting. We have activity-based budgeting. We have incremental budgeting. Incremental budgeting. We have feed forward control. So let's start with the first, the top-down budgeting. If it's top-down budgeting, the budgets are made at the top. So the seniors are going to come up with the budgets. Then the budgets are just going to be imposed on the juniors. So if this is where the juniors are not given room to participate in the budget setting process. So a budget just comes from the seniors and the juniors are told what to do. So this can be called imposed budgets. We can say these are also called imposed budgets. These are also called imposed budgets. They do not give room for the, they do not give room for the juniors to participate in the budget setting process. So the budgets are just going to be made at the top and imposed on the juniors. So the juniors have less room to participate in the budget setting process. So they are imposed budgets. So the challenge with this type of budgeting technique is that it tends to demotivate the juniors because sometimes the budgets which are set, they are unrealistic. The person who is setting the budget is sometimes not the person on the ground. So they make budgets based on what they assume to be taking place. So these type of budgets tends to be demotivating. However, they are fast because we don't need to include everyone in the budget setting process. So that is if it's a top-down budget. So it can be called an imposed budget. Besides a top-down, the opposite of top-down is bottom-up. So if it's bottom-up budgeting, the budgets, these are also called participative budgets. Participative budgets. The juniors participate in the budget setting process. The juniors participate in the budget setting process. So each department can set the budget. After they have set the budget, they submit it for approval to the seniors. So it is actually the juniors that are going to initiate these budgets. They set the budget at their departments, in their various departments. Then they submit these budgets for approval to the seniors. So this tends to be to provide more motivation because the juniors will feel like they are also being valued. They also contributed in the targets. The targets that have been set are realistic, and also the targets are applicable to their department because it is them that have set those targets. The problem is that the juniors may lack skills in eliminating the cost. They might end up incorporating certain things that are not supposed to be in the budget, and it can delay because if there are a lot of departments, each department setting the budget, it can delay and end up affecting productivity in the organization. We spend a lot of time talking about budgets, unlike a case where the budgets are just made at the top and the juniors have to just follow what's given. So that is the issue with the top-down and the bottom-up budgets. So the top-down and the bottom-up budgets. Now, let's move to the rolling budgets. So the rolling budgets. So rolling budgets, these ones can sometimes be called continuous budgeting. So in a rolling budget situation, the budgets are continuously updated. Think of a case, or maybe if we are to take things back home, if you look at you budgeting in ZIG or budgeting in local currency, normally now of late it has been stable, but before that, the currency was constantly changing in terms of its value. So coming up with a budget, maybe during the time where we were using the RTGS dollars, it was something that was difficult. You'd need to constantly update the budget because provided you're budgeting in local currency, it's likely to be affected by inflation or changes that are taking place in the market more often. So you can't update the budget after a year, or because maybe after a year, the prices have changed 4 times, 5 times. So a rolling budget, this budget has to be continuously updated. This is a budgeting technique where the budget is continuously updated. Where the budget is continuously updated. So the budget is continuously updated. It could be on a quarterly basis, it could be on a monthly basis. So that's a rolling budget. So this one, in terms of, if we use a rolling budget, the advantage of a rolling budget, we get accurate information, which is good for decision-making because we know the information we have or the budget we have, it's applicable to what's taking place in the current environment. But the problem is that it tends to be demotivating. Why? Because just think of a case where you were just left with 1 unit or just a few units to meet the target. Then you hear that tomorrow the budget is being revised. So when the employees are about to reach the targets can then be moved up. That can end up demotivating the employees. And in some cases also, we end up having a very huge bill for those that will be setting the budget because it has to be now done more frequently. So the budgeting process tends to be more costly and it can end up distracting production because frequently we have to be adjusting the targets, we have to be changing the targets. So that is the issue with the rolling budgets. But in terms of them being good, they are good in the sense that they bring accurate results, leading to better decision-making because we are dealing with updated information. Then we have the incremental budgets. Incremental budgeting. So if we are using the incremental budgeting technique for the incremental budgeting, how does this work? So for incremental budgeting, the budget is based on the previous year. It could be previous year results or previous year budget. So when you're creating a budget for this year, it's based on the previous year budget or previous year results. The budget is based on previous year results or budget. So if you're creating this year's budget, you can base it on the previous year budget. So if we are basing this year's budget on previous year budget, how is that going to be done? So we look at the previous year budget and consider, is there anything that needs to be changed? So if it's a large organization where, think of organizations where we are dealing with a lot of products, our revenue, we make, in a year, we make revenue of millions. So starting everything from scratch, it can become a challenge. So we might just consider, which areas do we need to change? If there isn't any change needed, we just continue with the amount that was on the budget last year. I think this is what most firms use. They will just consider, is there anything that we need to change from the last year budget? If there are no changes that are significant, we can just use the same results which were on the last year budget. So incremental budget, we look at the previous year budget and consider, are there areas that need to be adjusted? So for those areas that are still where there are no changes that have taken place in the market, we can still use the previous year budget or the previous year results. Then we just adjust for the areas where changes have been noted. So incremental budget, the budget is based on the previous year results. Or it could be the previous year budget. And adjustments made for areas where significant changes have been noted. So just make adjustments in the areas where significant changes have been noted. Make changes in the areas where significant changes have been noted. Okay, then besides the incremental budgeting, we also have, besides the incremental budgeting, we also have the zero-based budgeting technique. The zero-based budgeting. The zero-based budgeting. So if it's zero-based budgeting, it means when we are budgeting, everything starts from zero. So the term zero-based, we are not basing on any previous results. So when we are coming up with a budget, we start afresh. So when we are coming up with the budget, we start afresh. That's for the zero-based budgeting. So the budget is initially started from zero. The budget is initially started from zero. The budget is initially started from zero. So when creating the budget, it is started afresh from zero. Each department decides what to put in the budget. And then send it for approval. So there's an element of bottom-up budgeting. So for zero-based budgeting, the department decides, in our department, what is it that we intend to do during the coming period? Which activities are we planning to engage in? So after we've decided the activities that we are planning, we then consider the costs associated with each activity and come up with the alternative. For each activity, you must have alternative to say, we can either use this method or that method. Then from the alternative, you choose the cheaper alternative or the most beneficial. So you consider it being cheap and also it being effective. Then you choose the best for your department. After you've chosen the best for your department, you then submit the costs associated and the choice you have taken. So each department is going to do that. Then all that is going to be consolidated into one budget. So every department will participate. But the budget setting process starts from zero. We're not basing on any previous year results. Why do we do this? The importance of this is this type of a budget eliminates slack in budgeting. Just think of a case where we are using incremental budgeting. And last year, we made an error. Of course, there have not been changes, but there was an error in the budget we made last year. It means that error will still be carried forward. So for zero-based budgeting, we want to eliminate that. We want to make sure every budget stands on its own every budget is a realistic budget. It pertains to things that we want to do in the department. So for zero-based budgeting, the budgetary process starts from zero. When you're preparing the budgets, we start from zero. So that is the idea behind the zero-based budgeting. Now let's move on. So we've talked about the incremental budgets, the zero-based budget. The weakness maybe associated with the zero-based budget is that we have to be continuously, again, it has to involve all departments. So the budgetary process tends to be cost-consuming, and it might take long. It's cost-consuming, and it takes long. Then let's now look at activity-based budgeting technique. Activity-based budgeting technique. So that's ABB. So activity-based budgeting. So for activity-based budgeting, if it's the activity-based budgeting, it's based on the activity-based costing. If you still remember activity-based costing, under activity-based costing, we use the principle of cost pool and cost drivers. So this budget allocates the overhead costs based on the cost drivers. So if we have costs within the organization, such as rent, when you're allocating those costs, we apportion them based on the cost drivers to say which department is consuming more of these costs. So a department that is consuming more of the cost is also given more of the overhead. So we consider for each department, or for each cost, rather, what is the cost driver? If it's electricity, we consider what is causing the cost of electricity to go up. Then we share based on that usage. So for every cost, we are going to share it based on the cost driver. So this one is more of into how we allocate the costs, especially if the costs are being shared within the organization as a whole. So for every department, we have to allocate costs, but we allocate the overheads based on the cost driver, how each department is causing costs. A department that is causing a lot of costs, they will also, that is consuming a lot of costs, they will also get a bigger share of the overheads. Then we have feedback and feed forward. So feedback control. So for feedback control, this is a system where the actual results are assessed based on the predetermined, standards. So the actual results, we are assessing the results based on predetermined standards. So we set a standard. This one is not more of a technique we are going to be using to come up with a budget, but this one is for measuring performance using the budget. So feedback control, we want to control whether things are going well or badly based on the standards. You set a standard, then the actual output is compared with what was on the standard. So what was the plan saying? Then you compare what was on the plan with the actual results. So it compares what is on the plan with the budgeted, with the actual results. So it can be a positive feedback or a negative feedback. So if the results are better than the plan, it's a positive feedback. But if the output is below the plan, it's a negative feedback. Then we have the feed forward. The problem with the feedback is just showing us that we have less room to control that. So for feedback, it's showing us we've failed to meet the target, but we can't change it because it has already occurred. So to try to cater for the problem in advance, there is what we call feed forward control. Because feedback, yes, it can tell us we've failed to achieve the targets, but this is indicated after we have failed. So feedback is after we've already failed, but the feed forward is trying to look into the future. So for the feed forward, this involves comparing the budgeted with the predicted future outcome. So we are comparing a budget, which is what you think is going to take place, against, so you are comparing what you want, what you're budgeting against what you think is going to take place. So looking at what is currently taking place, what do you think is going to take place against the budget? So you're not comparing the actual results here. You are comparing the predicted outcome against, again, a budget. So you're comparing both forecasts. It's a forecasted budget and a forecasted outcome. So where you can predict that the budget and the outcome are not the same, or where you can predict that they are negative outcomes, you then take into account, you can implement measures before the problem takes place. So you are predicting that the budget is that you should produce 5,000 units, but you can see from the predicted results that you can end up producing 4.5. Then you start buying a machine now so that at least you correct something that, unlike waiting for you to produce 4.5, you then compare 5,000 budget. You predict the future results against the predicted budget, then you take action now. So the feed forward, it involves comparing a future budget with the predicted future outcome and taking corrective actions. So you take corrective actions. So you don't wait until things go out of hand. Okay, let's move on. Now I think let's move to the next. Topics. Most of other things here, they're just theory you can read. For budgets, the other things are just theory. You can read that. Now let's move on to the next topic, which is forecasting. forecasting. Forecasting, so if you're forecasting, you're looking into the future. Forecasting, that involves looking into the future. Forecasting involves looking into the future. So as a management accountant or a performance manager, you need to plan ahead. Remember, financial accounting is more involved with looking at the past of the organization. How is the organization performed in the past? But management accounting and performance management, it has to prepare for the future. So as management accountants or as performance managers, we are supposed to predict the future, plan for the future of the organization. So as we plan for the future of the organization, we need to apply a number of forecasting techniques. So forecasting, this involves, or we can say this is concerned with predicting the future results. So in forecasting, we are predicting the future results. We are trying to predict the future results. So there are a number of techniques we are going to talk about in forecasting. The first technique that we're going to use is the simple average growth model. Simple average growth model. The simple average growth model. This is used to determine the average growth over a period of time. So the simple growth model is used to predict the average growth over a period of time. So we can be told that, what's that? So we can be told that we can be given the sales for 3 years. Then we are required to predict the sales for the next year. So let's have a case, maybe we are given sales for year 1 and year 2 and year 3. So we have year and we have sales. So for the first year, year 1, the sales can be given as 1,000. Year 2, the sales can be given as 1.2. Year 3, the sales can be given as 1.6. So we are given these cells. Then the question says, what is the growth rate? What is the growth rate? Let me actually add maybe one more and say year 4 so that so we can add year 4 then. So we can add year 4. So for year 4, we can say 2,000. So the growth rate, the average growth rate, you can compare the growth rate on a yearly basis. From year 1 to year 2. From year 1 to year 2, what is the growth rate? We say change over original. So from 1,000 to 1.2, it would be that's 200. That's the change over original as a percentage. So that would be 20%. We come to here, that would be from 1.2 to 1.6, the change. Sorry? 33.3. So yes, that's 33.3. That would be, we are saying the difference, which is 400 over 1.2. Then for the last year, $0.25. So we've been calculating the growth per each year. So for the 4 years, or from year 1 to year 4, what is the simple average growth? So the simple average growth, from year 1 to year 4, you'd say 0.2, you'd add 0.2 plus 0.33 plus 0.25, you divide by 3. Since these are 3 growth rates, you divide that by 3. So 0.2 plus 0.33 plus 0.25. Overally, you divide all this, since they are 3, divide by 3. So the average growth rate as a percentage, the simple average growth rate is 26%. So the simple average growth rate there would be 26%. So that's how we can calculate the simple average growth rate. So we can then use that simple average growth rate to predict maybe sales for year 5. So would say so in other words, we are saying the sales on average from year 1, they are increasing by 26%. Year 1 increased by 26%, you get 1.2, you get, that's an average. But this one, it doesn't give us the accurate average. But this one is an estimated average. So for year 5, we can say, since we are increasing by 26%, so it means in year 5, the sales would increase by 1.26, 26%. So the sales would increase to something like 2.520. So this one is not an accurate measure, the simple growth rate. So if we want a bit more accurate measure, we can calculate what we call the geometric mean. So we can say the simple growth rate is less accurate. In order to increase the accuracy, we can calculate the geometric mean. So we can calculate the geometric mean. So we can calculate the geometric mean. So for our geometric mean, let me see if we're saying, so for the geometric mean, let's say for our question, which means we would be saying, so for the first year, it increased from 1,000 to 1.2. So in other words, it increased by 1.2. So originally it's 100%. Every amount is 100%. So if it increased by 20%, it's more like it's now 1.2, or it's now 120%. So for this first year, if an amount is increased by, if an amount is increased by 20%, it's more like it's now 120%, or it's 1.2. Then if it's increased by 33%, it's more like it's now 1.33. If it's increased by 25%, it's now 1.25. So the geometric mean then says the cube root of so you're saying cube root of those increments. So you're saying the cube root of, unfortunately, I can't put the cube root here. So you say the cube root of 1.2 plus 1.33 plus 1.25. So you get the cube root of that. 1.5? 1.56. So it means we are saying, if using the geometric mean, the growth rate using the geometric mean is, said it's 1.56, which is 56%. Let's move on. So they can say what is the growth rate using the simple average growth or using the geometric mean. Now we have the high-low method. Method number 2 that we use in forecasting, we have the high-low method. So we have the high-low method. So for the high-low method, what is this one used for? The high-low method is used when we are predicting the variable and the fixed cost. We want to split, we are predicting costs, but we need to, or we can say we can use it if we are predicting the future cost, but it's mainly used to split the costs into variable and fixed. So we are estimating the cost, but you want to come up with the variable and the fixed cost. That's when we use the high-low method. So the total cost function says that the total cost of a business is equals to the fixed cost plus the variable cost. The total cost is equals to the fixed cost plus the variable cost. So we can say total cost T is equals to fixed cost, that's A, plus the X. So what does this represent? T, that's our total cost. So T, that's our total cost. A, that's our fixed cost. A, that's our fixed cost. B, that's our variable cost per unit. Then C, X, that's the number of units. So if we are given, for example, that the fixed costs in total, the fixed costs are given in total are 34,000. And the variable cost per unit, each unit is a variable cost of $5. And the organization is planning to produce units, is planning to produce 200 units. Then what is the total cost? So the total cost that we'll be expecting here, you'd say the total cost is equals to our fixed cost, that's 34,000, plus the variable cost per unit, that would be 5, times the number of units, that would be 200. So simplifying that, this would give us what? $35,000. So 35,000 would be our total cost. Then the cases we are likely to get, in most cases, we might not be given, we are not given the variable cost per unit. So remember the formula, we need the variable cost per unit and the fixed cost and the number of units. So the high-low method is now used to get the B. If the question says what is the total cost, but you're not given the variable cost per unit, the high-low method says that variable cost per unit, that is the B, variable cost per unit in our formula, that's B, is equals to the difference in costs over difference in units. Variable cost per unit is the difference in costs over the difference in units. Variable cost per unit, the difference in costs over the difference in units. The difference in costs over the difference in units. So what's the difference in costs? The difference in cost in this case is for difference in cost, we can be given, let's put a point there. For the difference in costs, we have to be given, for the difference in costs, we have to be given 2 different levels of output and their costs. They can say we are currently producing the following units and the following costs are incurred So for 2,000 units, the costs are 24,000. If the units are increased to 2.4, the costs raise to 26,000. If the units are raised to 2.5, the cost will rise to 27,500. If the costs are, if the units are 2,600, then the cost will be 28,000. So what is the total cost for, what is the total cost for 2.8 units? So we want to calculate the cost for 2.8 units. So how can we get the total cost for 2.8 units? Of course, if we look at it, X is given. The units we know is 2.8. But we don't have the fixed costs. To get the total cost, we don't have the fixed costs in this case, and we don't have the variable cost. Of course, T is what you're looking for, but we don't have A and we don't have B. So the first step is to work out the value of B, which is our variable cost per unit. So calculating B using the high-low method would say the difference in costs. So for the difference in costs, you look at the highest and the lowest level of output. The lowest level of output is 2,000 units. And the cost for 2,000 units is 24,000. The cost for the highest level is 28,000. So the difference in cost, you are taking the difference in cost of the highest and the lowest units. That's 28,000 minus 24,000. Over the difference in units, you're taking the units of the costs that you have identified. So the highest units is 2.6 and the lowest is 2,000. So you then use that to get your B, which is your variable cost per unit. What's the value for B? $6.67. So the variable cost per unit is the same for all the units. The variable cost per unit is the same, or we can say the variable cost per unit and the fixed cost in total are the same for all units. What do you take note of this? The variable cost is per unit and the fixed cost in total. I didn't say the variable cost and the fixed cost and leave it there. The variable cost I'm talking about is the variable cost per unit, and the fixed cost I'm talking about is the fixed cost in total. So the statement is simply saying that we have calculated the variable cost to be 6.67. So the assumption is that for all these units, the variable cost is 6.67, and the fixed cost, which we don't know, is the same. So since the variable cost, we now know it is 6.67, we use that variable cost to get the fixed cost. So when you are now calculating the fixed cost, which is A, A. So to get your fixed cost, if we go to the question, to the statement that we drafted, if we come here to get A, you say total cost minus BX. So to get T, if you want A using your mathematics, it means A is equals to T minus BX. A is T minus BX, of which so when you're now getting the fixed cost, you take the cost for any of the units given, preferably take those you have used for the high-low method. So you can take the cost as 2.4 and the units as 2,000, or you can take the cost as 28,000 and the units as 2.6, and you substitute. So if you're taking the cost as 2,000, it means your T for the units as 2,000, the cost to be 24,000 minus the B is the variable cost. We said it does not change. Then the X, if we take 20, the X is the units. For the cost of 24,000, the units will be 2.4. We then simplify. What do we get? 10,600 and so this would be our fixed cost. That would be our A. Now we know the A and we know the B. We can now go and work out the total cost for 2,800 units. Because the formula says if you are getting the total cost, you say the fixed cost plus the variable cost plus the number of units X. So taking this further, it would be our fixed cost, that's our A, we've calculated 10,660, plus the B is 6.67, plus or times the X are the units, 2,800. So what would be the total cost? Sorry? $29,336. So that would be the cost here. So we have used the high-low method to predict the cost for 2,800 units. So where did we use the high-low method? We used it to get the variable cost per unit. Because for the information we're given, there wasn't any variable cost per unit. So after getting the variable cost per unit, you know it's the same for all these levels of units. Then you use that variable cost per unit to get your fixed cost. Now you have the variable cost and the fixed cost and the units, the 2.8. You then go and substitute into that total cost equation, then you get your answer. So the high-low method is another technique we use in forecasting. Besides the high-low method, the other technique also, we have the time series. Time series analysis. We have the time series analysis. So we have the time series analysis. So if it's the time series, we are looking at the change that is taking place over time. So for the time series, we are studying the change that is taking place over time. So this analysis This analyze the change taking place over time. So analyze the change taking place over time. So a time series analysis is components. So we have components of a time series analysis. We have the components of a time series. So the components of a time series, the first one is a trend. If we are studying the change that is taking place over time, we can have a trend. Then we have, besides the trend, we have seasonal variations. We have a trend, we have seasonal variations, we have cyclical variations. Then we have random variations. So if they ask you for the components of the time series, we have these components. We have the trend, the random variations, the seasonal variations, and the cyclical variations. If we are saying that there is a trend in time series analysis is the long-term movement. We are saying prices have been falling and rising, falling and rising. Let's look at a case like this. So let's have the following cells. So the cells, $1,000 for the first month. The second month, the cells were 1.5. The third month, the cells were 1.4. The fourth month, the cells were 1.450. The next month, the cells were 1.390, 1.460, 1.4, we can say 1.510, 1.540. So these are cells that are taking place over a period of time. Can you see at some point the cells were falling? The cells at this period, they were 1.5. At this period, the cells were 1.3. So at some point, the cells were rising. At some point, the cells were falling. But over time, what can we say? Check at the start of the period, the cells were 1,000. But at the end of the period, what cells figure? 1.54. So you can see that even though the cells were falling at some point, but overall, or if we look at the change over time, the cells have been rising. They've been falling, but over time, the cells have been rising. So that is the trend, is looking at the movement over time, the long-term movement over time. So we can't simply say, let's drop this product because the sales are falling, but it might be just a seasonal effect. But if you look at it over time, the sales might actually be improving. So that is the trend. So maybe putting it down, we can say a trend is the long-term movement in the values over time. This is the long-term in values over time. The long-term movement in the values over time. That is the trend. Long-term movement in values over time. The trend can either be upwards or downwards. This can either be upward or downward trend. This can either be an upward or downward trend. So the trend can either be an upward or a downward trend. Change that is taking place over time. It can either be an upward or downward trend. Then the other component of the time series is the seasonal variation. So if you're predicting the results that are taking place, you need to incorporate the seasonal variations. So what are the seasonal variations? These are short-term fluctuations. These are short-term fluctuations. These are short-term fluctuations caused by different seasonal effects during the year. So if our product is affected by seasons, there are certain periods where the product will be at peak, our sales will be high, and in certain seasons, the product might have low sales. So the seasonal variations, these ones are for the seasonal variations, there are certain seasons where we are affected by this. It's not in all seasons where the sales will be low. Then, like if it's ice cream, we might, in winter, the sales might be low, but if we get to summer, the sales can increase. So that we can say is a seasonal variation. So the sales over time, they are being affected by seasonal variations. So how do you tell this is a seasonal variation? The sales would drop in a certain season. The sales will drop every time in that year, in the year, that season, your sales will be low. So it means that one is just a seasonal variation. It's just being affected by seasons. Then we have cyclical variations. The changes over time, they can be affected by business cycles. These are long-term variations that repeat themselves. As a result of the business cycles. They are long-term. They are long-term. If compared to seasonal variations. So the cyclical variations, the economy at some point it can get into depression, and the sales can fall because we had recession, business activity is low. But this will affect along because a business cycle can run for even 10 years. So these are changes that would repeat themselves. Maybe after every 10 years, this repeats itself. So those are long-term issues, but these are not to do with your product only, but they're actually to do with the business environment as a whole. So these repeat themselves over a long time. Then there are also certain changes which are not predictable, which are not following a certain pattern, which we give the term random variations. So the random variations, we can say the random variations are due to unforeseen events. These are changes caused by unforeseen events. These are changes caused by unforeseen events and their probability of occurrence is difficult to predict. These can have positive or negative effect to the business. So we are saying that changes that can take place, they can be as a result of seasons, they can be a result of the business cycle, they can be as a result of factors we cannot predict. They can be factors that can take place that we cannot predict. These are just grouped and given the term random variations. So in total, we can say the changes over time, the time series, which is the changes over time. The time series is equal to the trend, which is T, the time series is equals to the trend plus, or let me just use the abbreviations here. So the trend plus the seasonal variation plus the cyclical variations plus the random variations, we use I. So the seasonal variations, let me put S. Cyclical variations, or the trend, that's T. Seasonal cyclical variations, then random variations, that's I. So when you're predicting, we do need to take into account the time series analysis. So the changes that take into account, that come into place over time. Those will impact on our sales, those will impact on the output or even the budget. So we should incorporate that into the budget. So let's look at how you can calculate the trend, or you can come up with what we call the moving average. So determining the moving average. So the moving average. So because of the trend, the change which is taking over, there are changes that we can say, like in this case. Let me take these cells. I've said these cells at some point they were falling, at some point they are rising. So for us to be able to pick the trend, so maybe let me for here, let me adjust this to 1.5. So the moving average, we have the 3-point moving average, or we can have the 4-point moving average. So if it's the 3-point, let's start with the 3-point moving average. So the 3-point moving average. We are saying, okay, the prices were falling, they were rising and falling. But what's happening on average? So the 3-point average, you'd add the sales for 3 periods, then you divide by 3. So the first one you write on that middle value. So you're saying 1,000 plus 1.5 plus 1.4. Then you divide by 3. 1,300. That's for the first one. Then you come to this one, you say 1.5 plus 1.4 plus that divided by 3. $1,483.3. Next one. $1,446. Next one. It's the same. $1,466. Okay, next one. What? Next one. Okay, so this is the average, the moving average. It's trying to deseasonalize or ignore the seasonal. We are looking at the average over 3 periods. So the average would show us a better view that, of course, at some points it was, we were looking at it as if there is a very sharp decline. But after we have averaged this, you can see from here, there's actually an increase to there. Of course, there's a small decline there, then it starts increasing. So overall, there is an increase. Over time, if we were to plot this, you'd see that the sales are actually increasing. The 3-point moving average, you count 3, then you put the average. Then you ignore the first one, you count the next 3, then you put the average. Doing that, continue doing that. So that's how you'd come up with the 3-point moving average. If it was the 4-point now, for the 4-point moving average, it's still the same, it's just that you're adding 4 now. But for the 4-point, you need to leave a space. I'll just, maybe let me just copy this first 3. I'll not copy, let me copy those first 4. So if it's the 4-point moving average, you have to leave a gap between your values. For the 4-point moving average, you need to leave a gap between each value. So you leave a gap between each value. So you start by getting what you call the uncentered 4-point moving average. You get the uncentered. Then you finally get the centered 4-point moving average. So for the 4-point moving average, you leave a gap. Let me add one more value there. From 1.5, the next one was 1390. So you add the first 4, 1, 2, 3, 4. After adding the first 4, the average, you write it in between the 4 numbers, the uncentered. So you're adding 1, 2, 3, 4. You divide by 4, you get the average, you write in between the 4 numbers. Eighteen 1362. About 63 if you round off. Then you add again the 4, leaving the first one. You add 1, 2, 3, 4, and you write here. $14.60. So you keep doing that. You keep going. Then the centered now, you add these 2. For the centered, you add the 2 and you divide by 2. So you'll be, if there was another centered, let me just give a random figure here. Let's say there was 1450 here. So for the centered, you would now add this one and that one, you put the average. It's now divided by 2. So you're saying this plus that divided by 2. 2093. Then you come here, you add these 2 again. So you now be, so for the centered, you'll be just adding the 2 and putting the answer in between. $14.55. 1455. So that's how you work out the 3-point moving average and the 4-point moving average. Then another technique we use in forecasting, let's have the learning theory. The learning theory. So for the learning theory, this is used when you are forecasting. For the learning theory, you use it if you are forecasting the hours. So it's a technique we normally use if you are forecasting the hours that you are going to use in production. So under the learning theory, the assumption is that if someone keeps repeating the same task over and over and over, they end up taking less time. So when you're budgeting labor, you do need to take into account that the more someone does something, the time that they take reduces. So under the learning theory, it suggests that the more someone repeats a task, the more someone repeats a task, the lesser the time they take to complete that task. So the more you repeat a task, the less time you take to complete. Initially, you can take longer, but the more you do the same thing over and over and over, the time you take tends to reduce. Why is it so? Because you start enjoying the learning effect. Repeating the same task result in you gaining what you call the learning effect. So the learning theory suggested that when you are learning, there is a certain rate that you learn. So you learn at a certain rate, which we call the learning rate. So for the learning, so you can say the learning effect occurs at a certain rate. So the learning effect, it occurs at a certain rate. The learning effect occurs at a certain rate. Then let's move on. For someone to enjoy the learning effect, there are factors that must be present. So for you to say, I've been doing this task over and over and over, and now I'm enjoying the learning effect, there are conditions that must be present. So you can say conditions that must be present for the learning effect to take place. So what conditions are supposed to be present for the learning effect to take place? Number one, the process must be labor intensive. So what learns is labor, it's not machine. So for the learning effect to be enjoyed, it must be a labor intensive process. So the process must be labor intensive. So machines are not capable of learning unless maybe if there is artificial intelligence incorporated, but the learning effect occurs in a labor intensive environment. Then number 2, the task must be repetitive. We must be repeating the same task over and over and over again. For us to enjoy the learning effect, the task must be repetitive. You can't be doing the task today and you repeat the task after 2 years. You won't enjoy the learning effect. But you see, I think this is where teachers, if a teacher is said to be experienced, what is it that we are looking at is because this person has been doing this over some time. So because of what they've seen, it means now they know maybe what is needed. Now they know the shortcuts. So if you had to take someone who is doing it for the first time and you compare with someone who has been doing it for 10 years, you can see the difference. Why? Because the difference is one has enjoyed the learning effect and the other has not yet. So the one who has done it for 10 years, they can be able to teach you in a shorter time and you can pass. Then the one that is still learning, they don't know the key areas, they don't know the important areas. So the learning effect helps you to perform the same task in a shorter period of time. Why? Because you have grasped the concept. Then also, there must be motivation. For the learning effect to come into play, there must be motivation. So the employees must be motivated. So the employees must be motivated because there isn't any incentive for me to complete in a very short space of time if the company will not reward me for that. If the company would say, okay, if you complete faster, we'll give you more tasks and we'll give you more pay, that can motivate an employee to beat the targets. But if you know the salary will be the same, or if you actually know if you complete early, they will give you more work, you would rather delay. So for you to enjoy the learning effect, there must be an incentive for you for completing fast. And lastly, the learning effect, the task must be new and complex. The task must be a new task and it must be complex. So you can't enjoy the learning effect by, if the question is 1 plus 1 is 2, no matter maybe you're given 10 years to do that, it won't, you can't say maybe now there's a shorter way of saying it. So it has to be something that is complex, something that can take you maybe 2 hours doing it. So with time, you can say the number of hours have reduced. So it has to be a complex task that requires you to maybe put in a lot of ideas, or that requires you to be more innovative. So you can say, now there are new skills that I've gained. Now I can be able to do it in a short space of time. So the task must be complex. So these are some of the conditions that must be present for the learning theory to be a success. So these are the conditions we need to adhere to for the learning theory to be a success. Then there is a learning curve. So there is a formula for the learning curve, which you cannot be required to draw a curve in the exam. So using the learning curve, it can help us predict to say, okay, if someone is learning at this rate, so after 100 units, what would be the time that they'll be taking? So if for the first unit, they can take 20 hours and they're learning at this rate, after so many units, what time would they be taking for each unit? So the formula is y. Y is equals to ax to the power b. Y is equals to AX to the power B. So B, I can't put the power B there, but the B is X to the power B. It's X to the power B. So what is the Y? The Y is the cumulative average time. It is the cumulative average time per unit. Y is the cumulative average time per unit needed to produce the units in concern. Needed to produce the units in concern. So if I'm saying the cumulative average time per unit, okay, I'll explain that more. Let's move. What about the A? A is the time needed for the first unit. Time needed for the first unit. X is the cumulative number of units produced. The number of units produced. So let's look at a case like this. The learning rate is assumed to be, the learning rate is assumed to be, let's say 90%. So the learning rate is assumed to be 90%. The learning rate is assumed to be 90%. And the first unit takes, let's say, 10 hours. The first unit takes 10 hours. Let's have a table like this, number of units. So you're gonna have the units, then you have the average time per unit, total time, so I'm going to deal with doubles. The first unit, if we double it, we get the second unit. If we double it, we get the fourth unit. If we double it, 8 units, then 16. So the time per unit, the first unit was said to be taking 10 hours. Then in total, it means the first unit would have taken 10 as well. Then we are told that the learning effect is that there is a 90% learning rate. So for the next unit, it would take 90% of 10. It would take something like $9. Sorry, not $9, 9 hours. So in total, what's 2 times 9? 80. Then we move on. For the next one, if we say 9 times 0.9, 8.1. So each unit is now taking 8.1. But in total, 32.4. Then 8.1 times 0.9, 7.3. What about in total? 58.3. $6.6. 105.12. So what can you note? Of course, the time is increasing. As we produce more units, the time is increasing. But what is happening to the average time per unit? Is falling. So the average time we are taking per unit is falling, but the total time is increasing. So the more we produce, of course, the total time will be increasing, but the average time per unit will reduce. So using the formula, Y is the average time per unit. So Y is now, okay, they can say, what is the average time for producing the 17th unit? So we were using the table like this, but the table only works for doubles. What if it's not a double? So the shorter way of doing it is using the formula Y is equals to AX to the power B. So Y would be, Y is the time, sorry, A is the time for the first unit. So the first unit we said it takes how long? It's 10 times, if it's now the 16th unit. The 16th unit, X would be 16. X would be 16. Then to the power B. B is calculated as follows. So B, to get the value of B, we say log of, it's the log of rate over log of R. So it's log of log 0.9 over log 2. So we are saying log 0.9 over log 2. What do we get if we say log 0.9 over log 2? 0.15. What about, is it 152? What's 152? Let's round it to 3 decimal places. Okay, so what do we get if we say 10 times 16 to the power negative 0.152? 6.561. So meaning if we round it off, that's something like 6.6, right? So this would be, so Y is a faster way of getting the average time per unit, provided there are no doubles. So I just used 16 so that to prove it would give us almost the same answer. What if the question had said the average time for the 23rd unit? If you want to use doubles, you won't get 23, or even if the question had said for the 12th unit, because part of this only works if we are using doubles. So the general formula gives us the average time per unit. So for any level of units, this formula works for any level of units. So A is the time for the first unit, B, so the X is which unit are we at, then B is log of rate over log 2. So Y is the average time, is the cumulative average time per unit. But if the question asks for the total time, they're asking for this. So the total time is this, the average time, which is Y. If the question just asks for the cumulative average time, 6.6. But the total time, it means we are looking for this. How do you get the total time? You multiply the average time by the number of units. So let's have that down. The average time per unit, that's Y. The average time per unit, Y, for the 16th unit is 6.6. But if the question wants the total time, if the question wants the total time, it is, if the question wants the total time, it is 105. If the question wants the total time, it is 105.12. If the question wants the total time, it's 105.12. How do you get the total time? So the total time, for the total time, you're taking the average time per unit, which is our 6.6. Then you multiply with the number of units. That's the average time times the number of units. Okay, so then there is one question which can ask you, what is the time? This is the average time. What is the time needed to produce the 16th unit? There is the average time per unit for the 16th unit, then the average time. So the question you can say, what is the time needed to produce the 16th unit? Take note, this one, it does not have an average. It's the time for the 16th unit, not the average time for 16 units, but the time for the 16th unit. So the first unit took 10 hours. But what is the time now that you take when you're now producing the 16th unit? So it's not 6.6. 6.6 is the average. If we add all the units from the first one up to the 16th and you divide by the time taken. But if you need the time for the 16th unit, you say the time for the 17th, you say the time for the 16th minus the time for the 15th. So if you want the time for the 16th unit, you say total time for 16 units minus the total time for 15 units. So the time for the 16th unit, you say the total time to produce 16 units, which is what you have been given, 105.12, minus the total time for 15. Unfortunately, we don't have the total time for 15 units. Using this formula, can you work out the total time for 15 units? Let's try, then we do it together. Total time for 15 units. Team? Oh, yeah, I did. And in about 26, one of clear squared. So what's the total time for 15? 99.93. So total time for 15 units, how do you get this one? Total time for 15 units, you'd say, firstly, you get the average time for the 15th unit, which is the time for the first unit, 10 times 15 to the power, yes, minus 0.152. You got what? 6.66. Then you multiply that by, so this is the average time per unit for the 15. Then for total of 15 units, total time, that's the T15. Total time for 15 units, 99 point. So the time for the 16th unit, you say the total time for 16 units, which is 105.12 minus the total time for 15 units, which is what we've calculated, 99.93. So it means the time for the 16th unit. The time for the 16th unit is that one. Take note, the question can say the time for the 16th unit, or they can say the average time. So those two are different. This formula gives us the average time per unit, but for the 16th, you have to do what you've done. For my team that's writing in December, don't worry the speed. I'm trying to cover for those that are writing next month. So you can come back for any questions. I'll assist you. I think I will let you know of the new timetable. I think maybe we might do Monday's evening if you guys are available. Okay, but for those writing September, any problems? Are we together? Okay, let's move. I think for now, it's worth just going into the questions, try one or two, so that we just check how far you have understood. Or before we get to that, let's just look at calculating the rate. So some questions you will not be given the learning rate. You have to figure out the learning rate on your own. So calculating or determining the learning rate. So calculating the learning rate. So the learning rate, in most cases where you're required to calculate the learning rate, that question will be having the doubling effect. There will be doubles. So like in this case, they can say the average time per unit for the 16th unit is 6.6. What is the rate? So let's just use the question that we have so that we want to reverse back to get 90%. So they'll say the average time for the 16th unit is 6.6. What is the learning rate? So you will use the formula A can say A r to the power n, A r to the power n is equals to the average time per unit. A r to the power n is equals to average time per unit, where A is the time for the first unit. R is the rate we are looking for. The rate we are looking for. Then N is the number of doubles. N is the number of doubles. N is the number of doubles. So let's save these variables down. So A is the time needed for completing the first unit, which is 10. The rate is what we are looking for. We don't know. N is the number of doubles. So N is the number of doubles. So you're saying how many times have we doubled to get to 16? So we have doubled 1 to 2, that's 1. 2 to 4, that's 2. 4 to 8, that's 3. 8 to 16, that's 4 times. So the number of doubles is 4. We have doubled 4 times. So our n is 4. Now using your maths, if we say 10, we don't know the value of r, 10r to the power 4 is equals to the average time per unit. They will give us the average time per unit as 6.6. So the first step is to divide by 10 both sides. Then you remain with r to the power 4 is equals to that 6.6 divided by 10, that's 0.66. Then in maths, if you remove to the power 4 from one side, it becomes, if you remove to the power 4, it becomes quad root, or to the power 1/4. So this is 0.66 to the power 1/4, or you can say quad root of 0.66. (0.90). So that is confirmed that our rate is 90%. Because 0.90 is a percentage, that's 90%. Or maybe let's end here. Then I want you to go and attempt more questions. Then we'll finish up this one. We'll finish up. I think there are areas I'm remembering that we just talk about. Let me just check. So just go and look at the questions on budgeting and also forecasting. Then we'll move to the next. So the next main area that we'll be looking at in our next session is supposed to be, let me go to my, so we'll introduce standard costing and variances, but go and do questions on this so that if there are any gray areas, we might look at them together. So for today, I think let's end here. Those online, thank you so much for your time. So those that are joining audit and assurance, we just have a very short break. Then we start at 1.